The calendar is turning and a significant date looms on the horizon for millions of student loan borrowers. Interest on your student loans is coming back next month. After a long period of suspended payments and zero interest, the pause is finally coming to an end. This can feel like a daunting prospect, especially as other economic pressures continue to impact our daily lives. It's a big shift, and understanding what it means for you is crucial. With the return of interest accrual, many borrowers are asking a critical question. Do you need to act now if you're in the SAVE plan? The Saving on a Valuable Education SAVE plan is designed to make repayment more affordable, but the end of the forbearance period requires careful consideration. We're going to break down what this means for you, helping you navigate the complexities and make informed decisions about your student loans. If you're one of the nearly 8 million borrowers in the SAVE repayment plan, you're likely wondering about the specific steps you need to take, if any, before August 1st. This plan has offered a lifeline to many, providing lower monthly payments and a path towards eventual loan forgiveness. But with the changing landscape, it's essential to understand how the return of interest impacts your strategy and what adjustments might be necessary. So, let's get straight to it. Here's the bottom line. We're going to cut through the noise and provide you with clear, actionable information to help you make the best choices for your unique financial situation. Interest will start up again on August 1st. Mark your calendars, set reminders, and prepare for this change. It's a concrete date that signals the end of the interest-free period and the beginning of a new phase in your student loan repayment journey. Understanding this date is the first step in taking control of your finances. But your payments are still on hold for now. While interest is resuming, the actual requirement to make payments is still paused, offering a temporary buffer. This doesn't mean you can completely ignore your loans, but it does provide a window of opportunity to assess your options and plan your next steps without the immediate pressure of monthly payments. This pause on payments is thanks to a general forbearance. The government has implemented this forbearance to provide borrowers with additional time to adjust to the return of interest and navigate the various repayment options available. It's a temporary measure, but it's important to understand its implications and how it interacts with your chosen repayment plan. So, do you need to switch plans before August? This is the question on many borrowers' minds. Should you stick with the SAVE plan, explore other income-driven repayment options, or even consider a standard repayment plan? The answer depends on your individual circumstances, your financial goals, and your tolerance for risk. For most, it's not required. You don't necessarily need to rush into making changes. The SAVE plan is designed to be a flexible and affordable option, and for many, it will continue to be the best choice. However, it's still crucial to evaluate your situation and ensure that you're making the most informed decision possible. But it depends on your situation. Your individual financial circumstances, your career path, and your long-term goals all play a significant role in determining the best course of action. What works for one borrower may not work for another, so it's essential to take a personalized approach to managing your student loans. If you're working toward public service loan forgiveness, a specific set of rules applies to you. PSLF offers a pathway to loan forgiveness for individuals working in qualifying public service jobs. Understanding how the forbearance and the return of interest impact your eligibility for PSLF is paramount. In this case, you can stay in forbearance. Remaining in forbearance will not automatically disqualify you from PSLF, but it's crucial to understand the implications for your qualifying payments. Alternatively, you can switch to another income-driven plan. Exploring other income-driven repayment plans might be beneficial, especially if they offer lower monthly payments or a more favorable path towards forgiveness based on your specific income and family size. If you stick with forbearance, it's important to be aware of the consequences. While it provides temporary relief from payments, it also means that interest will continue to accrue, potentially increasing your overall loan balance. The good news is, you can buy back these months later. This means that you can essentially retroactively make qualifying payments for the months you were in forbearance, ensuring that they count towards your PSLF eligibility. This allows you to get PSLF credit. It's a valuable option that provides flexibility and ensures that you don't lose progress towards your loan forgiveness goals. Now let's consider those who are aiming for income-driven repayment forgiveness. This is a different type of forgiveness than PSLF, and it has its own set of rules and considerations. In this case, switching plans makes sense. If your primary goal is to maximize your chances of receiving forgiveness through an income-driven repayment plan, Then actively managing your repayment strategy is crucial. That's because months in forbearance won't count toward your forgiveness. Unlike pslf, where you can buy back months in forbearance, income-driven repayment forgiveness programs typically do not allow this, and there's no buyback option. This means that every month spent in forbearance is a month lost in your progress towards eventual loan forgiveness. To help you navigate these complex choices, use the Federal Student Aid Loan Simulator. This tool is designed to provide you with personalized estimates of your monthly payments and potential forgiveness timelines under different repayment plans. This will help you to find your best fit. By comparing the estimated outcomes of various repayment plans, you can make a more informed decision about which plan aligns best with your financial goals and risk tolerance. Once you've made your decision, then apply online. The online application process is typically straightforward and allows you to submit all the necessary information to your loan servicer. What if you're not pursuing forgiveness? Perhaps you're focused on paying off your loans as quickly as possible, or you're not eligible for forgiveness programs. In this case, you can stay put or switch. The decision of whether to stay in the SAVE plan or switch to a different repayment plan depends on your individual financial circumstances and your repayment goals. But remember, interest starts accruing August 1st. Regardless of your repayment plan, the return of interest is a significant factor to consider. It will impact the total amount you repay over the life of your loan. If you can, consider making payments now, even though they're not required. Any payments you make during the forbearance period will go directly towards reducing your principal balance, which can save you money on interest in the long run. This will help you to avoid extra interest piling up. By proactively making payments, you can minimize the impact of the returning interest and potentially shorten your repayment timeline. Here's a heads up. If you do switch repayment plans, be prepared for some potential changes. You can expect higher payments on other plans, especially if you're switching from an income-driven plan to a standard repayment plan. Also keep in mind that processing might take a couple months. Loan servicers are likely to be inundated with applications and inquiries, so it's important to be patient and allow ample time for your requests to be processed. If you find that you can't afford new payments under a different plan, don't panic. You always have the option to remain in forbearance for now. This will provide you with temporary relief from monthly payments, allowing you to reassess your financial situation and explore other options. Just remember that interest will grow. While forbearance can provide short-term relief, it's important to be aware of the long-term consequences of accruing additional interest on your loan balance. Therefore, it's crucial to check out all your options. Take the time to research different repayment plans, explore potential eligibility for forgiveness programs, and understand the implications of each choice. And most importantly, stay informed. Rules may change again soon. The landscape of student loan repayment is constantly evolving, so it's essential to stay up to date on the latest news and policy changes. Still unsure about the best path forward? Don't worry, you're not alone. Many borrowers find the complexities of student loan repayment overwhelming. In that case, talk to your loan servicer. Your loan servicer is a valuable resource that can provide you with personalized guidance and answer your specific questions about your loan. You can also visit the FSA website for guidance. The Federal Student Aid website offers a wealth of information about student loan repayment options, forgiveness programs, and other resources. Ultimately, stay proactive. Your financial future depends on it. By taking the time to understand your options, make informed decisions, and actively manage your student loans, you can pave the way for a brighter and more secure financial future.